Can I invite you for the first question? Somebody's here really, he's feeling free to do. Dalibor would like to take the first question.
Thank you for this opportunity. I just wanted to ask the question about the savings targets, is 1.5 billion operational and the 500 million capex. How should we look at those? I mean, obviously, my understanding is, given the guidance, is that you're not expecting growth to accelerate. You are expecting some catch-up investments to be made, maybe in Algeria and Russia, and then capex will go down. But what does this 500 million actually mean? I mean, is that just that the capex will drop by 500, or that you will find some efficiencies and you'll be buying the same amount of equipment but 500 less? And the same thing for the operational, just to get a flavor of what this 2 billion savings mean.
Yeah. It's, am I right? Yeah. Dalibor, there is quite a few numbers maybe floating around right now, and Henk did another back of the envelope calculation now at the end. So I think our key message today has been that our strategy and our pledge to shareholders is really to focus on increased cash flows. And in order to illustrate what the objective set forth, mid-single EBITDA growth, lower capex, and in order to put a real number to that, if you do 2012 EBITDA minus capex, and you do the same exercise in 2015, we think it's possible to grow on an annualized basis, comparing 12 to 15, not repeating itself in 16, but comparing 12 to 15, we think it's possible to improve cash flows from operations by bringing up EBITDA, bringing down capex by $2 billion. That's the 2 billion. And then we split that in approximately 1.5 related to the more operational related part, and 500 related to network sharing initiatives, site sharings, etc. That relates to the capex. And then behind those 2 billion, there is, if you go into Russia, you will be able to reconcile Russia's contribution on all 4 building blocks, the 1.5 and the 500. Same with Maximo, Ahmed, and the other business units. So we have a consistent plan that's built on the value agenda with the 10 initiatives behind that adds up to an improvement around 2 billion. And then, of course, if you look to our objectives, I think we stretch ourselves. I think we put forward, we did that in November 2011 and we delivered, and I think we've done it again. I think a mid-single revenue CAGR of in today's telecom universe is a stretch target. We think it's possible because we believe in the data story. We believe in 3G in some of our markets, but at the same time we also have an Italian market that will not offer much growth. So I think the whole idea about today's session has been to focus on the cash flows and have that as the main strategy for how to create value for shareholders, and then give a stretched objective for the next 3 years on revenues, EBITDA, and what that will lead to in terms of leverage. That's been the whole purpose of all these numbers that maybe is floating around, and people need to reconcile. And please come with follow-up questions after the session as well if you need more guidance.
Maybe if I would want to.
Sorry, Dad, but can you use the microphone?
Just in case, you mentioned, Joe, you have an idea how much of this 2 billion should come from different regions. Would you give us a flavor about that?
The good thing about having a diversified portfolio is, of course, that in some markets we will do better, in others we will do worse than expected. So it's not a very different weighting compared to the size of the businesses. So it's not sort of a big hidden story in there that is a big surprise to everybody. I think it reflects basically the size of the businesses. And what I think is also very important here is that and that's why I like the focus on cash flows, because if, for example, let's take the Italian market, Maximo is slipping on his top line, even though he slips much less than his two main competitors. He compensates with cost cutting so that EBITDA is more or less stable, which is a great achievement in a difficult market. And then, of course, when we, in the end, are creating value for shareholders, we need to look at the cash flow. And then, in the end, we will also have to adjust CapEx and be more effective in terms of how we use capital in Italy in order to deliver the cash flow that is there. So even if you slip on your top line and you maybe not being able to grow a lot your EBITDA, I still think it's possible to set forth the cash flow targets that we have now decided to give as our value creation model for our shareholders.
Thank you. Okay, next question. Drivers. And then we're coming over there.
Yeah, so I have a question for Henk. If we go back to the tax and interest numbers that you outlined, so 3.1 in the last 12 months going to 2.9. The interest savings should be significant, but can you maybe break down, you know, how it's going to work between savings and interest and taxes going up?
Yeah. That would then be very close to giving exactly this roadmap that I explained to you that I would not give. But at least one component out of that improvement is clearly the full realization of the intercompany funding structure. So the financing company in place, between 13 and 15 billion of intercompany funding, will take care of, you could say, a tax saving, but to some extent is also linked, of course, to the interest mix that we have of 200 to 250 million. So part of that deduction is that block. The rest is the mix of withholding tax, the exact mix that we're going to choose with the gross debt, deleverage, and the leverage of the various entities in the group. So I'm not going to bring more detail there because that would be indeed too close to the roadmap, which of course we cannot give you. And then there is an increase of EBITDA. So the increase of EBITDA, which basically reflects more or less an increase of EBIT as a result of that, and that will lead to also a higher payment of taxes.
But if I would be to net it out, just in general terms, I guess the interest savings should be, I don't know, 300 million plus or so, just roughly speaking. And that means that, you know, taxes are going to go up. Isn't it the purpose of being headquartered in the Netherlands, you know, being tax efficient?
Yeah, of course, that is one of the focus for the whole group, to be tax efficient. But if the taxes paid go up as a result of a higher EBITDA, which is then mitigated by the fact that we have more efficient tax instruments in place, I'm factually very happy. If the only thing would be the tax instruments and no EBITDA growth, we would have a problem.
Thank you.
Yeah.
Okay, next question. There was here one, and then we come over to the front row on the next side.
Yes, thanks. Good afternoon, everyone. This is Stanley Martinez from Legal and General Investment Management. Henk, returning to the internal bank, which seems, dare I say, a fairly ingenious solution to potentially optimize your after-tax interest expense. Maybe you answered this in your answer to the previous question, but how much capital would you anticipate that internal bank would devote? Would it be, you know, would it be in the several billions of dollars, up to including all of the maturities that you would anticipate up to 2017?
Yeah, you have to be very careful with, let's say, mixing external positions with internal funding structures. On a consolidated level, this internal vehicle, of course, will be consolidated in the total of the group. So we will have an external debt position that is consolidated, and we will have a cash all added up in the group. And how we route it in the group does not have an impact, of course, on that. But the main thing we want to accomplish is to have about 13 to 15 billion of intercompany financing going through that vehicle. And because you do that in a way that you bring arm's length interest to the various operating companies, the operating companies fund their own requirements for expansions, for capex from that amount. You're able to collect interest income in the financing company.
Yes.
And that is being offset against a significant amount of tax losses that we have there. Of course, at a certain moment, you will run out of these tax losses. And then there will be a new phase developed for the financing company. It's a structure that can be on a continuous basis present.
If I can just ask two brief follow-up questions then, Henk. First, would you anticipate how much of a net interest margin, so to speak, would you anticipate earning internally within this internal bank, or I might call it an intermediate holding company, between what you would be able to borrow at externally between VimpelCom and what you would charge to the individual operating companies? And secondly, would this apply mostly to one operating company or to the whole range of operating companies within VimpelCom?
Yeah. We will, of course, try to utilize it for as many operating companies as we can, but some areas in the world prevent intercompany funding, for instance, so then we have to find other solutions or have limitations to that. But you like to use it for, if possible, for all of our entities in the group. The second thing is that it's dividends upstreaming, so you maximize the cash upstreaming in the group and then push it partially to external dividends and partially via the financing company into the entity. So that's more or less a cash round, but in between there is of course that interest then being charged to the entities. If you have direct funding from external into the financing company at a certain percentage, let's say 6%, 7%, then the normal spread you have on that is not much more than between 50 to 150 basis points, depending, of course, on the arm's length levels that you have in other parts of the world. And those can be impacted by the local circumstances very much. But on average, I would say between 50 and 150 basis points.
I understand perfectly.
That's, of course, different when you do your internal flow, because then you utilize your cash in a different way.
Thank you.
Yeah.
Okay, we move over there. Patricia, can you?
Hi, it's Barry Zaituni from Berenberg. I've got three questions. First of all, on the dividend, the 0.8 floor, that's based on the current number of shares, which I believe is going to change post the Altimo conversion. So should I be thinking of the 0.8 dividend floor becoming about 0.74 post the Altimo conversion? Is that the way that I should be thinking about it? And then my second question is, does your current net debt to EBITDA forecast exclude the $1.4 billion injection from the Altimo conversion? And then my third question is, if I simply take the back of a packet calculation that you did, gets you to 11.1 billion of EBITDA, then effectively, even based on your current debt, that's almost at current net debt, that's almost at 2 times. So if you're generating $4.3 billion of cash flow at that point with a floor of $1.3 billion of dividend, that's a lot of cash that can be put to work somehow and still get you to the net debt to EBITDA target pretty much. So how are you thinking of the excess cash at the moment in terms of capital allocation?
Maybe I can do dividend and then Henk can pick up the two other ones. Dividend is a supervisory board decision of VimpelCom, and the policy you see now we put in place in 2010 after the merger of VimpelCom and Kyivstar and establishment of VimpelCom Limited. That was sort of a hard target on $80 per common share, assuming 1.628 million shares. And that policy is still in place. And now with the 128 million shares being converted, the supervisory board need to revisit that discussion and that policy. And I expect after we have converted and revisited the discussion, we will announce an updated dividend policy. And there isn't all that many outcomes of that discussion. I think you could look at this as a dilution on the nominal number because there are more shares coming in, or you could choose potentially a more aggressive position saying that we keep the hard number, meaning that slightly more dividend will be paid in the years to come. And I think that's the judgment the supervisory board should look at, cash versus value. But I expect that we will be able to update a guidance on the policy after the next supervisory board meeting we have this spring in connection with the conversion.
Yeah, on the other points, this amount coming in from the conversion of the shares is not taken into account into these objectives that we mentioned. Basically also at the moment that we made all those objectives, this was not yet visible, and in any case, this needs, of course, further discussion with supervisory board also. But it is in that sense also not that very important, because as you made your calculation yourself, if we are able to deliver on the EBITDA growth leading to this 11.1, then today's level of net debt already is then very close to the ratio of 2 net debt to EBITDA, if you take then the EBITDA 2015. And then, of course, in the period, there will be relatively significant additional cash generation. So when I mentioned at the end of this finance presentation that we are, provided that we deliver on our plans, that we are in a very solid position with a range of opportunities for optimization, yeah, I think that is underpinned by basically the analysis you made yourself.
But let me also add there that, of course, this is something that is evolving. So we should also bear in mind that, for example, 3G, Ukraine, Pakistan, Bangladesh, is not factored in as an example. There might be things, other things happening on our journey towards 2015. So I still think that having the 2 target or below 2 as a guidance for late 2015 also is sending the signal of the debt level that we believe is sustainable and maybe also appropriate, even though it's not 100% reconciling with the lowest possible weighted average cost of capital. I still think that in a company like ours, in the markets we're operating in, that should be a debt level that is sustainable and maybe the right level also for giving the highest return on equity to shareholders.
Thank you.
Cesar, you raised your arm a couple of times. Can you give it thereafter to JP?
Yes, I have 2 questions. Can you, given your joint ownership of Euroset together with Megaphone now, can you please explain to us what changes are going to make to the business model, and what could be the impact of such changes on your Russian margin? And second, I've asked Anton about Russian capex, which he said it would go up slightly next year. How about the capex for the whole group in 2013? Will it go up or down? Thank you.
Yeah. Let's take the capex first. Last 12 months is around 19% capex to revenues. I think if we normalize it, it's slightly higher. If you then add in the catch-up, well, lower capex to revenues in certain markets, but also add in the catch-up in Algeria and Russia, I think the estimate on a group level for 2013 is around 21%. And then you will see a reduction in 2014, and I still think it's possible to get to 15 in 2015. I think Russia will be slightly higher than the group level on the guidance for next year. So that's where we are on capex to revenues in 2013. Euroset, we have also wired Anton, so if you want to jump in, Anton, let me just give sort of a short one first on Euroset, because Euroset is a quite interesting asset to be a shareholder in. So if we kind of leave the formula in terms of how we're going to drive dealer commissions down and how we're going to operate as a mobile company in Russia, and only look at Euroset as an investment, we sit on 50% of the largest retailer in a interesting growing market, and clearly now we would like to go in and try to develop that company together with Megaphone, and look at new revenue streams and use their fantastic presence in the market to see if we also can grow the value of that asset. So that in itself, it's an interesting asset, I think, to grow, develop, and own. But of course, and we need to have two thoughts in our mind at the same time. We need to have the thought I express now as a shareholder. How do we grow the value of the asset? And we will have a plan for that, and we have discussed different ways of doing that. And then we need also to look at Euroset as an important distributor that will have to sort of comply with the demands we have for lower commissions and more revenue-based commissions. And Anton can comment more on that. But I think at least the governance model that we have now established in Euroset is taking these two dimensions into account. And I think we have a good basis for both develop the company and deal with it when it comes to increased margins and appropriate dealer commission levels in Russia. Anton, you've been very much involved and personally negotiating, so you can feel free.
Yeah, just a couple of remarks. Obviously, the main intention is to move, and the main achievement as a result of this transaction for us commercially is to move Euroset to revenue share base commission, which happened as of 1st of January. Obviously, we cannot disclose the details of this commercial agreement, which is confidential, but judging from what we've seen from 2012, moving other distributors to revenue share model, that resulted in a reduction of level of commissions, and it resulted in the improvement in the quality of sales. Obviously, we're expecting similar improvements for Euroset. The second comment is concerning the future, how this asset can evolve. Just to continue with what Joe was saying, it's important to remember that Euroset is the largest distributor of handsets in Russia. And we believe that overall evolution in the market will be towards the share of smaller distributors is going to shrink, and therefore the market share of the large nationwide distributors such as Euroset is going to increase. Therefore, we believe there is an opportunity for Euroset to increase its share in the handset market and have a sort of better bargaining power in this respect in this market. We also focus on Euroset together with our new shareholder partner now, Megaphone, towards developing new revenue streams such as financial services. As you know, another operator in the market, Svyznoy, has been quite successful in developing financial product, leveraging of the distribution network they have to move the financial product, also to move travel product to support their online commerce activities. So these are all the areas we are looking to explore. So if Euroset will see the reduction of revenue from commissions from operators from SIM sales, we would like to see it compensated by the revenue streams from other sources and primarily from the handsets.
Can I just ask a very quick follow-up?
Caesar, can you use the microphone, please?
A very quick follow-up. Are you going to close the access to Euroset for MTS and the other operators?
The anti-monopoly agencies has instructed us and Euroset to provide equal sort of terms of access to Euroset, but we had a similar actually requirement from anti-monopoly agency several years ago when Euroset was initially acquired by VimpelCom, and I guess the game will be in creating commercial conditions which will motivate Euroset to sell our product.
Thank you. JP?
Hi, thanks. JP Davids from Barclays. Two questions, please. The first question to Henk, just on the in-house bank. You discussed a lot of the opportunities. Maybe you could just touch on some of the risks. I mean, I just imagine maybe foreign exchange being one of them. In a lot of these smaller markets, it's very difficult to access capital. And then maybe the second question is a slightly broader one. You delivered a very clear message on the value agenda here and cash flow growth. Do you think you're taking enough risk to grow this business over the longer term? And just as one example, you talked through partnerships of OTT providers. Isn't there scope to start buying some of those out or creating some of those yourselves? Thank you.
Yeah, first of all, on the risks. I think that the entity in itself that is going to be utilized as a financing company, as the in-house bank, that in itself, being positioned in the Luxembourg area, a relatively stable environment, we have gone through a risk analysis, of course. We do not see many risks in that part. But of course, if you start with intercompany funding, you always need to make the trade-off between what is the risk in a certain environment in which you are going to do the funding, how do you balance it with potentially taking local debt in the local market, if that debt is available. And particularly, I would say, in our Asian market, so in the larger areas, Pakistan and Bangladesh, we need to take that very, very carefully. Other markets have certain limitations on what you can do via intercompany funding. So that will always be the balance choice that you do on a case-by-case basis. But the risks, as long as you are aware of all these points, are all very manageable. But for instance, if you do intercompany funding and if you have intercompany positions, don't forget to go, for instance, to the national banks and make sure that you have got the various approvals to do that. So in that sense, you think about risks and you immediately think about the mitigation actions that are required. But it is an important point, and we do that basically every time.
I think the second question is of course a very broad, important question, and if anyone had the real answer to that, he would have a high market value, I think, that person. And Jan Edward can fill me in here. He knows this as well as I do. But I think our main product is the access product. We are building the infrastructure, and nice cars come and go. Right now, we know them as Facebooks and others, and I don't know which one they're going to be 5 years from now, but for sure, our infrastructure will be there to provide transport for whoever content provider that is there that would like to use our roads and our access product. So I think it's very, very important when you set direction of a big group like ours that we focus on something and focus less on other things. And we have decided now to focus on mobile access being the core and focus on cash flow generation from that core product. I see a lot of telecom companies now launching initiatives together with venture funds and investing in technologies, investing in content, etc., etc. I have also some background from private equity. I know how hard it is to really deliver the return. When you look at the returns that Henk talked about earlier today, I think we deliver a good return on our core product. So I think in VimpelCom we would be very careful to allocate a lot of money into venture-like technology bets or content bets in order to fill traffic into our networks, because that traffic will come from a variety of content providers and over-the-top initiatives and companies growing. That being said, of course, I can share with you a trip together with Ahmed Abudouma in Bangladesh and Pakistan. we had very interesting discussions with government representatives about the need also for local content and how can we develop local content as part of mobile health, mobile education, support for farmers. There is a variety, of course, of possible content-related concepts here that could be beneficial. And I think we will be selective. We will be very mindful. I'm not saying that we would never do a few bets on local content initiatives if we believe it makes sense. But and we also see that a lot of these concepts are growing at a much higher rates than, of course, the access product is growing right now. But still, I think we need also to be true and loyal and consistent in the way we operate. And for that reason, our capital will be allocated to access, capacity, coverage of wireless access. And the core product going forward is really access to the internet. So that's my best answer right now. I think it's going to be very hard for any investor in the future to hit a Google or a Facebook or something like it. But to stimulate maybe local content could be a role we would be considering with, I would say, limited capital allocation.
Okay, we move over to the next question there. We have time for 1 or 2 questions because otherwise we're running too far ahead. And then after that, Joe will make some closing remarks.
Hi, good afternoon, everyone. It's Vivek Khanna from Deutsche Bank. Thanks for your presentations. Hank, I had 2 questions on the structure, on the debt structure. One is about now, and the other one's about then, but I won't be asking you the roadmap in between. So the first one is just a little bit on process. How long is the in-house bank set up? How long would it take for that to be set up and running? And I'm assuming the equity capitalization can be done over stages. And then the second question is 2005 or later. When you've got an improved rating and lower leverage, and when your structure is such that you do have a financing company in place. I was just wondering how you're looking at going forward at debt at subsidiary entities, not in emerging markets, but some of the more mature markets, and if there's actually a need to actually have any debt at those entities at all on a longer term basis. Thank you.
The first point on the financing company, so we are establishing that company right now. And then over the next 2 years, 2-3 years, it will be let's say the amount that is in intercompany funding will be increasing to a level of 13 to 15 billion, as I mentioned. So that is taking place factually more or less as we speak. The second question, of course, is a little bit having 2 elements. One is, would it be from time to time be relevant to have local debt and not debt via intercompany funding in entities? I think I explained on the previous, one of the previous questions that indeed it might from time to time be relevant to do so. And of course, there is always, in the discussion in VimpelCom, there is that point on Wind Italy debt and debt that has no recourse on the group. To some extent, that is a plus for the total of the company. So we always will have to weigh the balance of pluses and minuses when we take a final decision on intercompany funding. But certainly, local debt will remain to be there from time to time.
Okay, Igor, that is probably the last one, but maybe it's a short question.
Yeah, I just wanted to ask a question about the strategic reviews for the smaller and peripheral assets in line with your portfolio management approach. Can you give us some comment on what's happening in Canada and in smaller African units more specifically?
Yeah. As we've said a couple of times, the contribution analysis and that portfolio has not a strict timetable linked to it. If we link this back to our strategy to, again, grow cash flows, I'm very happy that we were able to exit Vietnam. That was potentially an investment about $1 billion necessary to make that company cash neutral. And I think that's an example. That's a 7 market players. We had a very small market share. There are reasons why we ended up where we ended up. And I think that's an example of an asset that is supporting big time the strategy on growing cash flows. If we look to the small African assets, if we look to Cambodia and Laos, those are all more or less cash neutral. So there is no immediate need for a fire sale, for an exit, to accelerate anything with those assets. So we have time if we need to develop them into a certain stage before we want to consider an exit, we can do that. If we want to go faster, we can do that. And these are different considerations we're doing on the different assets. So there is no clear timetable or path on any of these smaller assets that we can discuss or disclose today. Canada is, of course, slightly different. Canada is, first of all, after the law on foreign ownership changed in Canada, we have now put in place, or OTH has put in place, certain actions to convert non-voting to voting to get a bigger control on what's going on in Canada. And there are also a couple of other things that will come out of that process that allows us to, on our own, decide the sort of the faith and the future in Canada. Canada is clearly a market where we need to put more money in order to generate a cash positive business. At the same time, it's a quite interesting market, so I think we need a little bit more time to consider what is the right thing to do there. But clearly, also Canada is among the assets in the contribution portfolio analysis as described. So it was a vague answer, maybe a little bit too general, but no specific, no clear timetable, no urgent need to do anything. But 7 of our 18 opcos, the 7 biggest ones, are generating 96% of our EBITDA, and I think that says something.
Sorry, I have to apologize to a lot of people who still have questions. You will have time to talk to management after the conclusion remarks with Joe. We will have drinks downstairs, but I would really ask you to ask the questions then, and would like now to hand over to Joe for his closing remarks of today.
Okay, I think you can just sit here. I'm going to spend just a couple of minutes actually. I think basically everything has been, we've said everything we want to say. And thank you also for a lot of good questions. We have an attractive footprint. We have growth in many of the markets we're operating in. We haven't launched even 3G in some of the markets. Our value proposal to shareholders has been said a number of times today. It's about growing cash flows. We think we can do that from operations, and we think we can do that by organizing our balance sheet and our financials in a different way. So we think there is a big upside related to both those areas. At the same time, we think also we offer a good combination of cash returns and growth in earnings in the years to come. With respect to the objectives that we talked about earlier today. And maybe as a final remark, I feel very good about the management team, the quality of people. I feel good about our business unit heads and also the the teams that they have around them, and I feel very good about the team we have in Amsterdam with Jan Edvard and Henk heading two very important functions, of course, in HQ. So I think we have the resources, the footprint, and the position to deliver, and we will keep you updated on any progress that we're making. So and we will hang around for a while downstairs as well, and if any more questions, happy to take them. Thank you very much for taking the time today, and all the best. Thank you.
Baby, listen, I need to get it out now.